So control versus ownership, and accounting spoke about this as well. Really, there's a massive difference in the psychology of a sophisticated investor and the average person. The main difference is that the average person focuses on cash flow and ownership, where the educated investors focus on building equity or increasing their good debt. And this is how really people get wealthy, just by buying a lot of properties, buy and hold, and then refinance, either live off the line of credit or trade shares or buy businesses that produce cash flow. So the true aim of a property investor is to maximise the amount of money that you control. A lot of property investors don't understand this. They think they're actually in the property game. You're actually in the money game. Property happens to be the asset class that you're investing into. And finance and money is what's going to get you from A to B. So I think the reason a lot of people are not actually getting a lot of success with property is because they're focusing all their attention and time on due diligence, understanding the property market, researching, finding the worst house in the best street, all these different things where in reality, sophisticated investors are experts on finance. They know the products that are available to them and they know how to leverage those products. So the more educated you become, and if you become educated in both, obviously you're going to get from A to B a lot sooner than otherwise. Now let's talk about the philosophy of money. So I'm going to go through a couple of quick products before I finish off. And really the philosophy of money is the key to understanding when you're looking at investing as a property investor. Interest is calculated daily on the principal balance outstanding and charged monthly in arrears. Interest saved is better than interest earned. By reducing your bad debt principal loan amount from day one, you can reduce an average 30-year principal and interest home loan down to 15 years and save potentially hundreds of thousands of dollars in unnecessary interest repayments to the bank. So when you actually take out a loan, what actually happens is, and I'll just illustrate this very quickly. And let's say this is a 30-year, $500,000 home loan, principal and interest. Every day, the bank actually calculates the amount that's outstanding on your loan. So let's say it's Monday, there's $500,000 outstanding, and they apply, let's say 8.5 is your interest rate, they apply the interest rate that day. Then they add up all the days in the month, and they charge you at the end of the month. That's how you calculate, and that's how you get charged, really, on your loan. Now, in the first 7 years, you hardly touch any of your principal amount that's outstanding. And your last repayment here, all the repayment is made up by principal. So the banks, what they do is, they make sure that they're covered first. They want their interest paid out first as a proportion of your repayments. And as time progresses, you're paying more and more of the principal off, with your last repayment consisting entirely of the principal amount. Now, who knows what an offset account is? Who doesn't know what an offset account is? I'll show you how to pay off your home loan very quickly without even being creative. Let's say there's a couple of you and you're both working and you're making money, and basically instead of paying this money into a savings account here, which has a BSB and account number, all you're doing is you're putting your money straight into your home loan account, which has an account number and a BSB number as well. So let's say you make, let's say $6,000 per month. Okay, so you get paid every fortnight, for example. Let's say you get paid monthly. At the end of the first month, what you do is you park your money into your loan. So there are days where your loan will be calculated not at $500,000, but at $494,000. And what you do is, instead of living off your pay, which now goes to your home loan, you've got a credit card for 55 days or 30 days, interest-free, which you use to pay all your bills, electricity, everything. Buy coffee, pay for fuel, pretty much everything. Before the interest-free period expires, your home loan pays off your credit card. So all you're doing is you're holding your money in your mortgage longer. Every day counts. Now, what actually happens is, and if we just go back to the slides, an offset account, and there's different types of offset accounts, and we can talk about different types one-on-one, and there's different ones that suit different clients. But the way it basically works is, over time, savings in your offset account can help reduce the loan principal amount, allowing you to pay off your home loan sooner or build up equity. There are two types of different offset accounts, 100% offset and a partial offset account. It just depends on what you want to achieve. But I'll show you the figures, and I'll show you a typical example of the impact of this particular facility can have on a couple making $55,000 each with a $500,000 home loan. In this example, everything is constant except for where the money is going. The money is no longer going into a savings account and then paying the mortgage. It's going to the mortgage first, living off a credit card, and then repaying the credit card. Now, this is number one, $500,000 loan, 8%, and that's your repayments. 30-year home loan, you're paying about $3,250 per year. This is at 8%. Okay, it takes you 30 years to pay off your home loan in that example. If you refinance that at 9.5%, which we don't even have available at the moment, but I'm just going to show you what if you refinance at a higher interest rate, but with an offset account, your home loan gets reduced to about 15 years. Let's have a look at the savings. $407,875.75. Who thinks that's pretty impressive? But guess what? Is that after-tax dollars or pre-tax dollars? How long would it take you to make $400,000 after tax? Think about it. 20 years? So people that have a principal and interest standard home loan, I mean, those loans products are completely outdated. There's no one that should ever have those products under any circumstances. There's just no advantage of having those products. So let's have a look at an example where we'll go ridiculous. Let's talk about structure versus interest rate, because everyone's really rate sensitive, because we know if the banks lower the interest rate, we're going to be $500 better off a month, right? We get those letters from the bank. So the banks know, they're very clever, and they've conditioned the market to be ultra rate sensitive. And that's why they advertise low rates, and that's how they get clients on board. Where what investors understand is that rates are not real. It's a structure that will actually save you money. Because at the end of the day, the most important thing is how much is going out of this pocket and going to this pocket. That's all that matters. Numbers are just numbers that can be manipulated. So let's have a look at an example where we've got a standard principal and interest loan at 6.5%, 30 years, compared to 11.5%, which we can't even do 11.5 if you wanted it. But I'm just going to go to two extremes to show you the difference in savings. This is your standard typical home loan, 6.5%, $500,000, 30 years. Now let's say you refinance at 11.5% and you set up an offset facility. There it is there. Let's have a look at the difference in money.